So hello friends, welcome to my channel. I'm in coaching center. So today I'm going to explain your introduction to accounting, third chapter, that is accounting standard concepts, objectives and benefits. So here you will learn about the concepts of accounting standard, and you will know about the objectives, benefits and limitations of accounting standard, and also you will learn the system of evaluation of accounting standards by the Council of Institute of Chartered Accountants of India, and you will be familiarized with the benefit with a brief overview of accounting standards in India. Now, introduction. So as you know, accounting is a language of business. Till from 2 chapters you have learned that only. So it helps that accounting helps to communicates the financial results. It communicates the financial results of an enterprise. It communicates the financial result of an enterprise to various stakeholders. The financial statement will be information will be communicated to the various stakeholders by the means of finance statement. They will communicate that information. If the financial accounting process, if it is not properly regulated, it is not properly followed, there is possibility of finance statement being misleading. It will be misleading, or there may be some wrong values may be happened, or balance sheet may not tally. This may happen, and tendentious and providing a distorted picture of the business, for giving the what the PJ is, how the business is going, providing that information. Health is the accounting rather than the true state of affairs, giving the correct picture of the business, what is happening, how much we are getting profit or loss, how much we are in which. More information we get in the accounting through this. And in order to take transparency, consistency, comparability, adequacy and reliability in the financial reporting, you have to take these. You have to be essential. It is essential to standardize. It is more important to standardize the accounting principles. It is most important to standardize your accounting principles and policies. Accounting standards, ASS, it provides a framework, it gives a framework and standard accounting policies, or the accounting policies, so that it may help the financial statement of different enterprise to become comparable. The financial statement of different enterprises will make it comparable with each other. Now, concepts. So accounting standards, they are written policy document that are issued by expert accounting body. They are written a body document, and they are issued by the expert accounting body, or by government. It is written by the government or other regulatory bodies that are covering some of the things like recognition, treatment, measurement, presentation, disclosure of accounting transactions, who are treating that, and events in the financial statements also made by them. So the ostensible purpose of setting bodies, the purpose of standard setting bodies is to promote the dissemination of timely and useful financial information to investors, to give the information to the investor about in which position they are standing, and certain other parties also, to give the information to certain other parties having an interest in the company's economic performance, who are having an interest to know about the company's economic performance. For them, giving this information is known as the standard setting is a financial statement, or financial statements, you can say. Next, and many other things. So the ostensible purpose of standing setting bodies is to promote the dissemination of the timely and useful financial information to its investor, to give the information to the industry, to its investor, and certain other parties having an interest on their company's economic performance, who want to know about their company's economic performance. Giving the information for them is called as the standard setting bodies. And there are The accounting standard deals with the issues. The accounting standard, they have some of the issues like recognition of events and transaction in the financial statement, measurement of the of these transaction and events, presentation of these transactions and events in the financial statements and presenting in a manner that in a meaningful and understandable manner, understandable to the readers in the presentation, and to disclosure that requirements. To disclose the requirements, we should be that to disclose that requirement that should be there to enable the public that should be there to enable the public at large for in a large and stakeholders and the potential investors are in particular, and to get an insight into the what these financial statements are trying to reflect, and thereby facilitating them to take prudent and informed business to take the correct decision, giving helping them. Next, objectives. So the whole idea of accounting standards, the whole idea of accounting standard is centralized around harmonization of accounting policies. By changing the accounting policies and practices that are followed by different business companies, so that to diverse accounting practice, so that to know about the accounting practices adopted for various aspects for accounting, for various aspects of accounting can be standardized. It may be standardized, and accounting standardize diverse accounting policies. It has some of the views like eliminate. It tries to eliminate the non-comparability of financial statement, and thereby it helps for providing reliability and financial statements, and it helps to provide a set of standard accounting policies, valuation norms and disclosures that are requirement, and also it helps to in the preparation of financial statements within the bound of rationality. Thereby it ensures it gives us information about comparability of the financial statement in the different enterprise. Next, benefits and limitations. So accounting standard, it helps in the it describes the accounting principles, the valuation techniques, and the methods of applying the accounting principle in the preparation and presentation of financial statement. How to put that, and so that they may give a true and fair view about their accounting statement. It will help by setting the accounting standard. The account and has following benefits. The accountant will get some of the benefits like standards reduce the reasonable extent or elimination. It a standard accounting standard, it reduce the reasonable extent or elimination. Although confusing variation in the accounting treatments used to prepare financial statement, there may be some confusions, but still it helps to reduce the reasonable extent or elimination it does. And there are certain areas where important information are not statutorily required. There are important information. There are some places where important information are not required to be disclosed. They should not be disclosed. Standards may call for disclosure beyond the required by law. Beyond that, they are required by law. So the standards they may call say as to close that, but still there are. But still the accounting standard says to close that thing, close that disclose it, but still beyond that required by law, but still they so till to disclose it the standard. Next, the application of accounting standard would to a limit extent. It may extend to a limit, facilitate comparison of financial statements of companies that are situated in different parts of the world. The financial statement of the companies by taking the comparison of financial statement of the companies that are situated in the whole world, and also of different companies situated in the same country. There are different companies that are situated, comparing their profit or their growth or to the other companies, comparing. However, it should be noted in the respect. It should be noted in the respect that different institution, transaction, legal systems from one company to the one country to the another, they give rise to difference in accounting standard. They may give rise to difference in the accounting standard adopted in different countries. However, there are some limitations of setting of accounting standard. They are alternative solution to certain accounting problems may each have arguments to recommend them, may each have some arguments to recommend them. Therefore, the choice between different alternative accounting treatments may become difficult. There may be a trend towards rigidity and away from flexibility by applying the accounting standard, and the accounting standard cannot be override the statute, and the standard are required to be framed within the privilege statute only. They should not override it. Next, overview of accounting standard in India. So, in India, the Institute of Chartered Accounts of India (ICAI) being premier accounting body in the country, it is a premier accounting body in the country that took upon itself as the leadership role for constituting the accounting standard board. They took up the leadership role. That is ASP accounting standard. ICAI took the leadership role on 21st April 1977, and the main function of ASP is to formulate the accounting standards so that they may establish so that the standards may be accounting standards may be established in India by the Council of ICA. The Council of the Indian Institute of Chartered Accounts of India, they have so far issued three accounting standards they have instituted. However, AS8 on accounting for research and development, they had been withdrawn consequent to the essence of AS26 on the intangible assets, and thus effective. There are 31 accounting standards at the present during now. There are 31 accounting standards, and the accounting standards that are issued by the Accounting Standards Board established standards. They establish the standards which have to be compliant by the business entities, so that the financial statement are be prepared. The financial statement of the company may be prepared in accordance to the general accepted accounting principles. The financial statement may be taken. List of accounting standard. So AS1, it tells us about the disclosure of accounting policies, and AS2 revised, it tells about the valuation of inventories. AS3 revised, it tells us about the cash flow statement. AS4 revised, it tells us about the contingencies and events occurring after the balance sheet date. And AS5 revised net profit or loss of the prior period items and changes in the accounting policies. It tells us about that. It gives information about these things. And AS6 revised, it gives us about the depreciation accounting. It gives us information about depreciation accounting. AS7, it gives us information about accounting for construction contracts. It gives us information. AS8, withdrawal pursuant to AS26 becoming mandatory. So it gives us information about accounting for research and development. And AS9, it gives us information about revenue recognition. AS10, it gives us information of about sorry, 1 minute. So AS10, it gives us information about accounting for fixed asset. AS11 revised, it tells us the information about the effects of change in foreign exchange rates. AS12, it gives us information about accounting for government grants. AS13 gives us information about accounting for investments. AS14 gives us information about accounting standard. In this accounting standards, it gives us information about accounting for amalgamation. AS15 revised, it gives us information about employee benefits. AS16, it gives us information about borrowing costs. AS17 gives us information about segment reporting. AS18 gives us information about accounting standard of related party disclosure. AS19 information about accounting standard. It gives us information about the leases. AS20 earning per share, it gives us information. AS21, it gives us information about consolidated financial statements. AS22, it gives us information about accounting for tax on income. Next is AS23. It gives us information for accounting for investment in associate in consolidated financial statement. AS24, it gives us information about discontinuing operations. AS25, it gives us information about interim financial reporting. AS26, it gives us information about intangible assets. AS 27 uses information about financial reporting of interest in joint ventures. AS 28 it gives us information about impairments of assets. AS 29 about provision, contingent liabilities and contingent assets. And AS 30 financial instruments recognition and measurements. AS 31 financial instrument presentation. AS 32 financial instrument disclosure. So these are the things. Now let us know. So a brief overview about the mentioned accounting standards that we have given below. Here let us see a small overview. So the first one here you saw, that is disclosure of accounting policies. So disclosure of accounting policies, it was issued in 1979, and this standard it is related for the presentation and disclosure requirement of the significant accounting policies. The presentation and requirement of the disclosure of the presentation and disclosure of the requirement of the significant accounting policies that are followed in preparing financial statements, that helps in the preparation of financial statement. The true and fair state of affairs and the financial results of an entity. The true and fair and financial statement of an entity is significant affected by the accounting policy followed in an accounting. It may affect the accounting policy followed in an accounting. The areas in which different accounting policies can be followed or accounting for depreciation, revaluation of inventories, valuation of fixed assets. In many things we can follow different accounting policies. The disclosure of the significant accounting policies, it should form the part of the financial statement. It should be a part of the financial statement, and any change in the accounting policies which has a material effect, in current period, it has a material effect, or which is reasonably expected to have a material effect, it may have the material effect in the later periods, and for that reason it should be disclosed. And if any of the fundamental accounting assumption is going to concern consistently and accurate is not followed in financial statement, the fact should be specifically disclosed. Next is valuation of inventories, that is revised 1999. So AS2 is a measurement. It is a measurement related standard and species. The method of computing of cost of inventories, and the method of determination of the value of the inventories, that should be shown in the financial statement. As per the standard, the cost of inventories should comprise the cost of purchase. The cost of inventory should compare the cost of purchase and costs of conversion and other costs incurred in bringing the inventories. They should become one to bring the inventories valuation practices. The revised AS2 drastically reduce the alternative choices. AS2 means valuation of inventories, reduce the alternative choices. They will not have any alternative choices. The revised standard permits the use of only FIFO or weighted average cost formula for determining the cost of the inventories, where the specific identity of the cost of inventories it is not possible to get. The standard also dispenses with the direct cost method of permits only the absorption costing method for arriving at the cost of finished goods. Next is cash flow statement, that is revised in 1997. This standard deals with the provision of information. About the historical changes in cash. It tells us about the historical changes in cash and cash equivalents of the enterprise by means of a cash flow statement which classifies cash flows, that classify the cash flow of cash during the period or into operating, investing, or financial activities, it stops the cash flow. And the cash flow statement is an important part of financial statement and helps in assessing the ability of that enterprise, helps in the knowing about the ability of the enterprise to generate the cash, to make the cash, to earn the cash, and to cash equivalents, and to enable the users to give to help the users to develop models to assess and compare the present value of future cash flow of different enterprises, to know about the present value and the future cash flow of the enterprise. And the requirements of presentation of cash flow statement that will force the management to strive to improve the actual cash flows. It may force the management to improve the actual cash flows rather than the profits, which is ultimate goal of any business entity. That is ultimate goal of any business entity, is to improve the actual cash flow rather than getting the profit. Next is the contingencies and events occurring after the balance sheet date, that is revised 1995. So, pursuant at AS 29, provision contingent liabilities and contingent assets, because they are becoming mandatory in respect to accounting period commencing on or after 1st April 2004. All paragraphs of AS4 that are dealing with contingency standard, they withdraws except to the extent they deal with the impairments, to the extent they deal with the impairments of assets that are not covered by any other Indian AS. And the project of revision of the standard by ASB in the light of newly issued AS 29, that is in still progress. As the present standard AS4 that deals with the treatment and disclosure requirements. It tells us about the disclosure requirements in the financial statements of events that are occurring, that are getting after the balance sheet. The information we get, events occurring after the balance sheet date, the events we get after the balance sheet date, or those significant events that are occurred between the balance sheet date, that those the balance and the AS4, it deals with the disclosure requirement of the financial statement of events that are occurring after the finance statement, that are occurring after the balance sheet. They are the events that are occurring after the balance sheet, or those events that occur between the balance sheet date, and the date on which the financial statements are approved. The date they occur between the balance sheet date and the date on which the date on statement and the date on statements are approved by authority by the authority of an entity. They approve this. Next, AS5. AS5, it is the net profit or loss for the period. So prior period items and changes in accounting policies revised 1997. This statement should be applied by an enterprise in presenting profit, in showing the profit and loss from ordinary activities. To show this, the enterprise will apply this statement. Extraordinary items and prior period items in the statement of profit and loss. In accounting for changes in accounting estimates, and disclosures of changes in accounting policies, for changes in accounting estimate, and disclosure of changes in accounting policies. As per AS5, prior periods items or incomes or expenses that arise in the current period as a result, they are said as the result of errors. They are the result of errors or omissions They are the omissions in the preparation of financial statements of. They are helps in the omission in the preparation of financial statements of one or more prior periods. So extraordinary items or incomes or expenses that arise from events or transactions that are clearly distinct from the ordinary activities of the enterprise, and therefore are not expected to recur frequently and regularly. They are not expected to recur frequently and regularly, and the prior period and extraordinary items. The extraordinary items are required to be disclosed. They are not to be disclosed in the profit and loss statement as the part of the net profit of the period, with separate disclosure of the nature and amount to show the impact of current year's profit or loss. Next is the depreciation accounting revised 1994. This standard requires that the depreciable amount of the depreciable asset should be allocated. On a systematic basis. It should be allocated on a systematic basis to each accounting period. It should be allocated on a systematic basis to each accounting period during the useful life of the assets, and the depreciation method that are selected should be applied consistently from period to period. They should apply these things consistently, and if there is a change in the method of providing depreciation, if they have any change in method, such a change should be treated as a change in accounting policy. They should treat these changes change in accounting policies. And accounting policies and its effect should be quantified and disclosed. That effect should be known and it is disclosed. In case any depreciable asset is disposed of, known, it is we know about the deferred, discarded or demolished. The net surplus deficiency, if material should be disclosed separately. Then the material should be disclosed separately, and the depreciation method used and depreciation rates are also required. The depreciation rate are also to be required. It should be disclosed in the financial. They should be also disclosed in the financial statement. And during the period into operating in investing and financial activities, the cash flow statement is an important part of financial statement. The cash flow statement is an important part of financial statement and helps in assessing the ability of the enterprise. The ability of an enterprise to generate cash, and cash equivalents, and enables users to develop models to assess and compare the present value of future cash. To know about the present value of future cash flows of different enterprise, and the requirements of the presentation of cash flow statement would force the management to strive to improve their actual cash flow rather than profit and ultimate goals of any business entity. So here what will the same thing but little bit they have. Sorry. I think I came to that page only. Sorry. Okay. No problem. Next is AS7, construction contracts revised 2002. So according to this, the standards prescribed. The standard prescribed. हाँ जबंदे. Next is AS7. The standard prescribes the accounting treatment of revenue and cost associated with the contracts, with the construction contracts by laying down the guidelines regarding to allocation of contracts revenue and contract costs of accounting periods in which the construction's work is performed. Since the construction activity is generally contracted and completed in the more than one accounting period, but still an enterprise is required to disclose the amount. You should know about the it should disclose the amount. You should disclose the amount of recognized contracts revenue with the methods used to determine that revenue and the method applied in determining the stages of completion of contracts in progress, both are in progress. As per the standards, the gross amount due from and to customers for contract with work as shown as assets and liability respectively. And accounting for research and development, these stands withdraw 1st April 2003, the date from which AS 26 on intangible assets becomes mandatory. Next, revenue recognition issued 1985. The standard, it deals with the basis for recognition of revenue, the recognition of revenue arising in the course of ordinary activities from the sales of goods, rendering of services, and from income from interest, royalties, and dividends in the profit and loss statements. They should give from the enterprise should give. Next, according to the standards, revenue is gross inflow of cash. The revenue is gross inflow of cash, receivables or other consideration arising in the course of ordinary activities that are arising in the course of ordinary activities of an enterprise. From a sales of goods, from the rendering of services, and from the use by the others of an enterprise resources yielding interest, royalty, and dividends. These are some of the course of ordinary activities of an enterprise. Next, the revenue arising from construction contracts, hire purchase and lease agreements, government grants and subsidies, and revenues of insurance companies from insurance contracts are outside the purview of AS9. And in addition to disclosure required by AS1, AS9 requires an enterprise to disclose the circumstance in which revenue recognition has been postponed. It has been postponed and pending the resolution of significant, and that is uncertainly. Next, accounting for fixed assets that are issued in 1985. The standards that deal with the disclosure of the status of the fixed assets in terms of value, and the standard that does not take into consideration in the specialized aspects of accounting of fixed assets that are reflected with the effects of price escalation, but that also applies to finance statements on historical cost basis. And it is important to note that from the date AS22 on intangible assets that are becoming applicable to the relevant paragraph of this standard that are dealing with the patents and know how have been withdrawn, and an entity should disclose the following information that are the gross and net book value of fixed assets at beginning and the end of accounting period, showing addition, disposals, and acquisition and other movements. And they should disclose about the expenditure incurred on amount of fixed assets in the course of construction and acquisition, and they should relieve that relieved value amounts substituted for historical cost of fixed assets. for historical cost of fixed assets with the method applied in the computing the really revalued amount in the financial statement. So okay, till here it is enough. So okay friends, I will explain the other concepts of your chapter, accounting standard concepts, objectives and benefits, in my next video. So if you like the video, please like my video. So how was my explanation? Did you understand? Please leave a comment, and for more videos like this, please subscribe my channel and coaching center. So I will see you in my next video. Till then, take care, have a nice day, bye my dear friends.